So Tarun has, I have to request the panelists that in the interest of, we have 2 hours, so there's a fair amount of time. But I'd request the panelists, I know that some of, the Tarun has slides, and I think Renuka and Monika also have slides, and Rajnish doesn't have slides. So
I made them in the last session.
you made slides already.
Last session.
Oh, you made slides, so everybody has slides.
Only because the kids made it.
Oh, okay. All right. So we're going to have a plethora and a richness of slides. The only worry about slides is that, you know, if they take up too much time, then we won't have enough time to engage. So just please be judicious in how long you spend on your slides. It's my only request. I'll just hand over to Ashok. The genesis of this session has to do, and I think truth in advertising, we have to mention that, conversations that Tarun Ramadorai and I have had emerging out of the paper that he and Vimal Balasubramaniam did last IPF on the balance sheet of the typical Indian household. And we thought this would be a good thing to marry it with financial inclusion and beyond. But we should also just in passing mention that Tarun has headed a committee that has been sponsored by RBI on household finance, and the report is not yet out, but it is under review at the RBI. So I'll leave it at that and hand over to Ashok Lahiri. And thank you, Ashok, for agreeing to do this.
Thank you, Shekhar. Now, I must tell you that we have a very strong panel, and since I was chairing the session yesterday, they were kind enough to meet with me. We have agreed on a few rules, which is each panelist will spend 12 minutes on presentation. I'll just make 3 opening remarks. First, financial inclusion and household finance landscape are related issues. And Tarun, as Shekhar meant the point, he has got a paper. So you can ask the question, why do households operate financially the way they do? And that is important in finding out where do we stand in financial inclusion. Second, what is financial inclusion? Let's be very clear about the definition so that there is no ambiguity. Financial inclusion is giving access to the formal financial sector to the marginalized and formal finance deprived sections of society. Now you can have all sorts of financial instruments, say derivatives, options. We are not talking of that. We are only talking about banking services, remittance, then insurance, some pension, and basic credit. Now, does it mean that there can be a millionaire who doesn't go into the formal financial sector? No, we are not interested in that. It's only the marginalized. And the third issue is the policy related. You can have all these discussions, then where do we go from here? And these are the 3 signposts that I will basically mention and leave it to the panelists. Now we have decided that Tarun will lead the discussion. He has got a presentation. After Tarun, it's Monika, then it's Rajnish, male, female, and then Renuka will end with her presentation. Tarun.
Thank you. Okay. Can we put it up on this? Oh, there we go. Great. Okay. Thanks very much. Monika, do you mind if I just?
No, please go ahead.
Lovely. Okay. Great. So thanks for inviting me to the NCAER IPF. Well, I would just say the IPF, but thanks DG Shah for all you do for us. So this was another useful consequence of this panel, which is that Ashok Lahiri has now coined the term DG Shah to describe Shekhar. He is the Director General after all. So this is about the Indian household finance landscape. I won't be saying much about anything about the work that the committee has done, but I will be talking about my IPF 2017 paper with Vimal and Christian.
Tarun, after 10 minutes, I'll give you a signal.
Sure, that's absolutely fine. I won't even need that much. So I think Ashok mentioned this a little bit early on, which is that there's an important area of policy in India, which is financial inclusion. And the sort of stated goal of this is how do we bring all of India into mainstream financial markets? There's been a growing body of academic work in this area called household finance, which is closely related, which is that the unit of analysis here is household balance sheets. Now, there is a distinction to be made between household finance and financial inclusion. Obviously, household finance exists whether or not households have been included in formal financial markets. They still have balance sheets. And it could be the case, of course, that if once they're financially included, it might not be the very best thing for them because it depends a lot on how efficiently they use the formal financial instruments in the market into which they've just been introduced. And so in some cases, if you don't efficiently use the formal financial markets, and households aren't very well prepared for this, in some cases the supply side is set up in such a way that it may not be prepared to sort of get households the best possible start, then there are situations in which including households may actually be worse for them. So I think it's sort of important to consider all of these possibilities. There are assets on household balance sheets, there are liabilities on household balance sheets, houses, gold, retirement savings and insurance, and the liabilities include things like collateralized and unsecured loans. I should just point out that this is an interesting field because anything that you do in one part of the balance sheet obviously has implications for other parts of the balance sheet as well. So there are complex interconnections between the different elements of the balance sheet. So you can't just take on sort of a debt instrument and expect that it doesn't affect your demand for certain types of assets. Gold actually serves as a store of collateral in household portfolios as much as it does an asset into which they sort of invest. So there's lots of issues here about the effects on your balance sheet of things that you do. There are interesting life cycle dynamics and wealth dynamics. So there's a whole field of research in asset pricing which tells you about how households should optimally allocate their portfolios across their life cycles. And so this requires interesting analysis that sort of draws from different areas of finance. Both corporate finance, corporations manage their balance sheets, and asset pricing in the sorts of tools that we use. A new subfield of this is something that John Campbell and I have been working on for some time to launch. We have this website called www.householdfinance.net. We hope that most of you will go there. And we have an annual review of economics article with Christian Bardarinza where we try and sort of pilot this methodology using balance sheets from different countries. So I'm going to try and show you what we've done on Indian data, which is very similar to the paper. In fact, it sort of draws directly from the IPF paper, which studies the All India Debt and Investment Survey 2012 and then tries and compares that to different countries. So we find basically four broad features in the IDIS data, which is that Indian households have a very high allocation to non-financial assets. So this is pretty well known, but we sort of document the extent of this. Both gold and real estate are extremely high relative to other parts of the world. High levels of non-institutional source borrowing, which many people have documented in the past, many in the development finance literature in particular. So we have lots of great people here. Near complete lack of pensions and extremely low levels of insurance penetration, both life and non-life. And of course, Sean's done a huge amount of work in this area as well. What we bring to the table is we show, Christian, Vimal, and myself in our IPF paper that these facts are unusual in the international context. And in work that I'm not going to show you, we also show that when you build a canonical life cycle model, portfolio choice model for India, and calibrate it using Indian income processes, you still can't rationalize some of these patterns using the Indian context. Okay? So let me try and show you a few sort of pictures to set the tone. So these are the allocations of household wealth. So this is the asset side of the balance sheet. And the bars here are India, China, the US, the UK, Australia, and Germany. And so these are all drawn from the representative household surveys in each one of these countries. So for example, in the US, this is a survey of consumer finances. In Australia, this is HILDA. This is the Wealth and Asset Survey in the UK. And this is the All India Debt and Investment Survey in India. So if I just looked at sort of equal weighted average percentages, what you'll see here is these are just percentage allocations on the balance sheet for people who invest in each of these things. So the average Indian household holds roughly 77% of their assets in real estate. And you can see that that's quite different. It's much higher than any of the other countries that you see here. If I look at gold holdings, they're a substantial part of the Indian household balance sheet, but you'll notice that gold is basically absent in any other balance sheet in these other countries to quite the same extent that you see them here. And there are hardly any retirement assets or pensions, even though you can see that these account for a larger fraction, especially in the sort of more advanced economies. Although in China, of course, you're seeing less pensions. So these are sort of differences between India and the rest of the world. And on the liability side, again, you see that there are substantial differences between India and other countries. Mortgages are households' largest liability in pretty much all of these countries. In India, of course, mortgage penetration is extremely low, even though real estate penetration is really high. So households are basically holding a huge amount of home equity as their principal source of wealth alongside gold, and this is quite unusual. And the other thing that we'll notice is that most debt is unsecured in India. Okay, so conditional on having debt, and Indian households are generally debt averse, they have quite a bit of unsecured debt. Okay. Now, you can also sort of look at these patterns in a different way, which is you can look at each of the countries plotted as a line, and then you can look at this across the age distribution. So this point here is households that are less than 35 years of age, 35 to 44, 45 to 54, and then over 65. And this represents participation rather than asset allocation. So this is what fraction of these people at each one of these age groups participates in each one of these asset classes. And so this one here is about financial assets and pensions. And you can see that in India, the participation rate in financial assets, this includes a bank account, for example, is far lower than in these other countries. But you can explain this partly by development. You can see that in China, it's actually roughly similar. And in fact, if anything, India is slightly better off. If I look at gold, India is right up there. They actually have lots of durable goods in gold, or many of them have it. So this is participation. And again, there's massive participation in real estate. Okay, so you can see that these patterns start to sort of appear pretty quickly. Leaving aside these things here, this is participation in mortgage loans. In most countries around the world, you see the typical hump-shaped pattern. As households earn more and more income, their indebtedness also rises. And then as they sort of move into their retirement years, they draw down, they pay off their mortgage loan debt. So this is a sort of reasonably typical pattern that is predicted by most life cycle models. In other countries, it's far more pronounced and getting down to zero participation towards the end of life. In India, on the other hand, rather worryingly, if anything, you see a rising participation rate over the life cycle, which is kind of unusual, but it sort of speaks to the informal arrangements that exist in the country. You can see similar patterns, again, in terms of the allocation of the life cycle on the asset side of the balance sheet, conditional on households getting into these assets. And here, again, you see this overexposure to non-financial assets, real estate, gold, and pensions are a negligible fraction of the assets on Indian household balance sheets. Okay? So I'm not going to spend too much time on this thing. I will just point out one thing that I think is important, which is if I take Indian demographics and if I take Indian wealth levels and I plug them into a model that basically is generated by estimating this stuff on other countries, I still can't explain what's going on in India. So it isn't as though the differences between India and the other countries of the world can be well explained by the fact that Indian demographic characteristics or wealth levels are very different from those in other parts of the world. So a way to think about this is India's real estate holdings. This is the real estate holdings of the other countries of the world. This is the predicted real estate holdings for India if it behaved in the same way that the other countries of the world would behave. But in fact, you see that there's a big gap between what India holds and what India is predicted to hold based on its demographic characteristics. And you can see these patterns in financial assets, in pensions, in mortgages, and other secured debt, and in unsecured debt. So massively higher unsecured debt, lower mortgages, higher real estate, lower financial assets, lower pensions. So there are discrepancies on both the asset side and the liability side of the balance sheet. Okay, so all I'm trying to get at here is that there are big differences. These require some explanation, and it's interesting to sort of scrutinize these differences. These are just patterns that are coming out of the data. There's no causal analysis here yet. There's no structural model that I'm showing you right now, but it's interesting nonetheless to sort of consider what causes these differences. So now, obviously, Indian household financial demands are complex. Okay, so there are questions here about what cognitive capabilities people have to make complex financial decisions, what behavioral considerations, if any, exist. Obviously, in India, there are many idiosyncrasies arising from occupation, from the fact that they're located in very vastly different geographical areas of the country. There are traditional systems of risk sharing that might be in operation. And in turn, there are unique economic conditions and financial goals that Indians have. So I think sort of at this point, to open up the discussion, I'd say that, you know, there's a question here about what kinds of solutions you might contemplate. So hand it over to Monika.
Thank you. You're well within the time limit. Monika, you have to follow Tarun's
Yes, absolutely.
example.
You know, it's good that it comes immediately after Tarun's presentation because he gave the problem set that Indian households have this fixation for gold and real estate. And I'm saying that it's a blame which has been thrown very often at the Indian household, that they're non-sophisticated, irrational, they like gold and real estate. There was a FM in the past who said, just stop buying gold because the import bill was so large. I'm saying that it is not a demand-side problem, it is a supply-side problem. The Indian household is making a rational decision by staying with products that he or she understands, and also is not very clear about the safety of even the regulated parts of the market. Some of the numbers are here. This is what investors have lost. This is something that I have documented in a paper with Renuka, Sané, and Susan Thomas. This was 1.5 trillion over a 7-year period they lost in lapsed life insurance products. 30,000 crore is they're still losing in traditional products. And I mean, this data is, it's there. The marketplace is fragmented. There are similar companies doing similar things with very, very different rules. So the household is very confused as to what he should buy, who he should go to, and what product is the household finally taking home. My postulate here is this. My proposal is that we look at the problem from the supply side. We move from a buyer beware market to a seller beware market. So what is the current market structure? It is a buyer beware market in which financially literate, utility maximizing economic agents choose the products they need once firms make full disclosure. Any of us who've tried to buy a financial product will know how this actually doesn't work on the ground. There are enough studies which have shown that financial literacy, the way that it is done, does not work. The efficacy is tending to zero over time. But what about disclosure? Indian regulators have taken a very lazy way to deal with disclosure. They throw masses of information at the household. They say, disclose all material information. And that means masses of legalese, which make very little sense to anybody. Most disclosure is fuzzy and obfuscating. And I will give you an example from the life insurance industry. I choose life insurance because it is really, it's an industry which manages assets rather than provide risk cover. So it's a 25 trillion assets under management industry. When we look at this illustration, I've taken the name of the company away, and there is just fine print which tells you a little more information. To be fair to the company, because all companies disclose returns like this, what is the impression in your mind? What is this 13, 12, and 11%? It is, I think it's a return number. But it is not a return on your investment, it's a return on something called the sum assured. So when you do the math, the return on your investment is 3.5%. There is another illustration. There's a premium paying term in insurance of 10 years. At the end of 10th year, 50% of sum assured comes to you. 11, 12, 13, the percentage of sum assured goes on increasing. The disclosure says that the return is 396% of sum assured. Not many people understand that 396% is not your return is 4.2%. What does the regulator do? Does not ensure that the 4.2 number is disclosed. Every advertisement, every illustration is cleared by the insurance regulator. So we have a regulatory failure of a massive scale where products are being sold on the basis of not returns but something else. I can give you lots of examples. The same thing happens in, say, mediclaim policies. How is a person to choose? You're supposed to understand claims ratios, right? How well does the firm deal with claims which are made? IRDA recommends that you club group policies and individual policies. Group ratios are far higher than individual ratios. So the disclosure is meaningless to me as an individual. And we can go on and on about the failure of disclosure. But let's assume that disclosures, that this is the regime that we have. Do the disclosures in place work? Renuka, Sané and I have a paper where we audited 400 bank branches in Delhi. And the auditors asked basic questions on the features of products. And we found this is the number of percentage of incorrect disclosures on basic product features. How much does this mutual fund return? What has it returned in the past? What does this product cost? What is the lock-in period? What do I lose when I redeem the product early? This is the percentage of incorrect disclosure. So even the disclosures which are there, simply not being, the disclosure mandate is not being followed. And then we wonder why households buy gold and real estate. So the immediate reform will be to get a regulatory buy-in and a common approach to disclosures, as they should be. You should at least disclose what it returns on the investment that I make, what I lose if I redeem early. So some material disclosures are to be made which make sense to investors. And I must tell you that if you look at Bose Committee report, I was a member on the Bose Committee report, in the annexures is a document which Mr. Bose managed to get from UK, which discloses an LIC policies illustration. I mean, to anyone who's interested, do look at that disclosure and look at your own policies, and you will see the difference. When firms are pushed, they disclose properly. What is my solution? I'm saying that we need to focus on product structure. By product structure, I'm not saying we tell them what to make. It's a very basic thing. I'm saying, can we just put all the costs in a box and label it as costs? Or do we have to have fragmented costs across the product which nobody will understand? Put all the costs in a box and label it as costs so I can compare across similar products. Align the incentives. This is finance. It's not so tough to do. Make the incentives so that it is in the interest of the producer, the distributor, and the consumer to manufacture, sell, and buy the product which works. Align incentives. And then for the joker who still runs over the red light and kills somebody, very, very massive fines. This is not something Indian regulators are known for. The UK, Tarun would know, has done much more in terms of penalizing firms which have caused harm to household finances. Is there evidence? I will very quickly run through two industries. So there's a mutual fund industry which had regulatory action, and there's insurance industry. The monkey has gone out of the mutual fund product in India, where the front load is out, costs are in a box. You can compare. Even upfronting of trail commissions, there are rules around that. This whole process took 10 years. The monthly retail flows into equity funds is over 4,100 crore a month now. That's retail money coming month after month after month. This just shows you that 10 years of change, what it does to the gross assets and the net assets. The red bar is showing net assets, and we also know that distributors are churning less. So if the net is near zero, whatever is coming out is going in. Like, so they're just simply churning existing portfolios. But we are seeing better behavior in the mutual fund industry. What happened in insurance industry in 2010? The regulator caused arbitrage. Within the market, they cleaned up the ULIP product, but not the traditional product. ULIP became transparent, costs could be counted. The traditional product, which is your endowment money back, still remains an opaque product, which are the illustrations that I just showed you. You don't know what you're buying. What does the industry do? It flips. The red line is the traditional first-year premium, and the blue line is the ULIP. So the industry in 2010, you see the inflection point, it just flips. So what is being sold now is the traditional product. So ULIP is now a better product, but what do they sell? Traditionals. Why does it matter? It matters because these are 15, 20, 25, 30-year products, and they die after the first 5 years. There's a number called persistency, which means how many policies sold today are alive after 1, 2, 3, 4, 5 years. IRDA in its wisdom does not map the data for a 20-year product beyond 5 years. So the best we have is a 5-year persistency. That number in India is 44. So 56 out of 100 policies die by the time you reach year 5. My hunch is by the time you reach year 10, 15, 20, 90% are dead. They're not being funded anymore. For some firms, this number is 80 to 85 out of 100 policies are dead. Why is this a problem? It's a problem because the way the traditional product is structured. And remember, this is 25 trillion rupees of AUM. Don't forget the size of the problem. Is that if you lapse your policy, if you don't pay your second or third premium, the insurance company, according to the regulator, according to rules, can appropriate your premium, book it as profit after 2 years. This is shocking. We've worked with the regulator over time, but this is not something which makes any difference. So there is incentives built into the regulation which encourage manufacturers and distributors. So distributors take home about between 40 to 80%, 45% legitimately and 80% illegally of the first year premium as commission. So it is hard sold. Second premium comes, third year he lapses it, that entire money is lost, it's a trap. And then we wonder why households buy gold and real estate. We will have to think about putting in place a set of rules, and the Bose Committee has really mapped that, which have similar rules for similar products. And we also need to understand, if you pull this thread long enough, you understand that India is in a case of textbook financial repression, because who buys, what are the products which these insurance companies buy? The rules are such that they buy G-Secs, government bonds. So you've set up the game to appropriate cheap household savings for buying government bonds, but then now the game has gone out of hand and households are losing real money. One way to fix it would be to move to a seller beware market, where the responsibility is on the seller, not for a good market outcome, but for suitability. And that's a whole new conversation. Thank you.
Thank you. Rajnish.
Thank you, Suman, for inviting me and so making me part of this distinguished panel. I thought this was a panel discussion till very recently, and I thought I would speak here, but my young colleagues here all informed me that they had presentations. So the last hour and a half I made one. So this is not actually a presentation, it's some thoughts, which I had thought I'd bring them up here and we could discuss them. Okay. So what's financial inclusion? So look at the title. It's financial inclusion and beyond, and then understand. So it's a very broad mandate. So I would look at it, and I think Ashok and I are on the same page here, is access to instruments for consumption smoothing and risk sharing. And that would be instruments to save at a reasonable real rate of return. That would include savings for retirement, which is a large part of savings. Instruments to borrow at non-usurious rates of return, means that transactions cost should be about, approximately small for the borrower, and instruments to insure against idiosyncratic shocks. Could be accidents, could be health insurance, etc. One point that I wanted to make is that the poor are not a scaled down version of the rich. Having spent a lot of time building model planes, I learned it the hard way that you could not build a plane which was a shrunken size of a large plane. And Devesh and Anupam are here, so I have to tell them what is conserved is the Reynolds number. You really can't shrink things. And I want to illustrate this with one of the problems we face these days is the following, that financial instruments that are appropriate for affluent consumers in developed economies probably are not appropriate for poor houses in developing economies. So you really couldn't say that we have these financial instruments and I'm going to provide them to you and there will be financial inclusion. Providing access to these instruments may not result in financial inclusion. And one of the problems is that fixed and transactions costs become of first order importance when you start looking at poor households. So with my very poor skills, I drew this cross. So there's a developed countries here, developing countries here, and rich and poor. This is what basically we study in mainstream economics. You got complete markets and you abstract from fixed and transaction costs. We study convex economies, and all of these things are abstracted from. If you live in India, while you may not have the complete set of financial contracts, it will be incomplete markets, but still we know how to study these markets pretty well. The poor in developing countries, again, I'll illustrate this in the next slide. You cannot abstract from fixed costs and transactions costs for them, because the loans and other things that they take are quite small. And actually, let me show you a picture here. I wanted to bring this up. I got this from one of my exams that midterm exams that have. So financial inclusion or lack of is not limited to developing countries. You see this this is from New York Times, okay? And these type of loans actually run at 700 to 1,000% APR, and they are flourishing, payday loans, etc. And the reason is that if you were to take out a loan for the same amount and fill out all the paperwork, etc., it'd probably be equally expensive, or if not more. So this is not a problem. This is coming to the Indian poor. This is incomplete markets, and you cannot abstract from transactions costs and fixed costs. And you are squarely in the realm of non-convex budget sets and things like that. So the problem is of mechanism design. You really have to work from the bottom up to design products for this group. You cannot import products that are successful in those markets. And there has been a lot of progress. There's a lot of progress in the last, I would say since 2011, there has been a tremendous amount of progress. One of the person, actually Viral Shah, who worked very closely with Nandan, was a former student of mine at Santa Barbara, and I spoke with him before this talk, and he filled me in on some of the advances in technology that have taken place and large database management system. Like we could manage today a database of 1 billion people quite easily. That's a large database. So traditional financial instruments are being redesigned, branch banking is being replaced, mobile money is coming in, and this is something that Airtel actually is, trumping M-Pesa in Kenya with MasterCard. They have this plan there with smart cards. Kohli has started this, and anywhere MasterCard is accepted, you just fill up your, top up your cell phone, and then you can pay any merchant which takes a credit card. So things are advancing very rapidly. How many minutes do I have?
You have exactly another 5 minutes.
Okay, good. So now I wanted to, next thing is some issues that are specific to India. One of the things that I think is what is unique to India is financial inclusion for migrant laborers. Given regional differences in growth rates, there is a lot of labor mobility in India. Looked up some numbers, and there are at least about 100 million. That's 10% of the population which move annually. And compared to agricultural households, migrants are characterized by high-risk occupations, erratic incomes, shorter life work, and early retirement. So their life cycle is also quite different from a normal agricultural worker. And most migrants are employed in the informal sector, and as a result, these sectors do not provide them with insurance in case of accidents or illness. So you really need some specialized financial products such as portable pension plans that you go from from one job to another job to another job, some disability insurance. But the lack of a verifiable address is a huge impediment for financial inclusion. And even for the payment system, if they are to remit things back home, most of them rely on Hawala couriers, which knock off about 5% of That's a huge transactions cost for just transmitting some money. Finally, I want to touch on alternate mechanisms for financial inclusion, and that is, if you look at 1 kilowatt hour of electricity, and if you're connected to the grid, it costs you no more than 25 cents. That's an upper bound. The same amount of electric energy from D cells would be $50. So this imposes a huge transaction cost on poor households that do not have electrical connection. And lack of electricity has consequences that affect all aspects of life. In addition to an adverse impact of productivity, education, health, security, it is completely essential for powering mobile phones and network connectivity, and these are two essential concomitants for your traditional financial inclusion. And this is a guy I'm very impressed with what he's doing. Paul Needham is the founder of SIMPA. He says there are many ways to affect financial inclusion. Most people think immediately of things like microloans, bank accounts, credit cards. We saw a need to create a financial product that's designed for the energy poor. A financial solution then that can help make clean, reliable electricity affordable for the mass market, and they're marketing in Haryana and they're marketing it in Uttar Pradesh. And basically, I have a slide that SIMPA sells small solar power home systems, which power a couple of LED lights, a fan, and a mobile phone charger. That's it. Now there's no fixed cost. So they got rid of this fixed cost. It's basically pay-as-you-go system. The household pays for the electricity it reuses. Each payment adds towards the purchase price, and after 2 years, the system is fully paid for, and the household owns the system. So this is both, a mechanism designed for buying these things, and it's all by mobile phones. It's basically the payments is on the mobile phone. Finally, I wanted to talk about holding gold, and I would say that it's an optimal response to historical expropriation. If you look at the travelogues of Tavernier and Bernier, they describe in detail life in the Mughal courts. They had the Mansabdari system, and one particular feature of this system was that when the gentleman died, all property reverted back to the emperor. They did not want dynastic continuation. So what would a rational person do there? I mean, if you wanted to give something to your descendants, you would put it in the form of gold and jewels and some portable assets along that line. That led to perverse incentives, and it continued for a long time. I mean, that's basically one of the things. So culturally, this is something that came through over years and years of expropriation. Thank you.
Renuka, 12 minutes.
Thank you everyone for being here, and thank you for inviting me to speak on the panel. I want to begin where Dr. Mehra left off, which is that he was giving us an example of a market-based solution where you had this company and that sort of came in and was able to solve the fixed costs problem of providing electricity. And I mean, I know this is an example that we keep hearing again and again, but I want to reiterate it. If we think of telecommunications in India, we know how this market has evolved over the last 20-30 years, right? So we had an objective, then we had state-driven supply that didn't get us very far. We recognized the need for a market, and then we set up market-based solutions so that the private sector could come in, and the results are there for us to see. So I don't want to say that what was done in telecom is exactly replicable in finance. And that we should just let the market loose. But I want to make the point that the way we have dealt with issues in finance, which is a very sort of mandating state-owned banks to do or meet a particular objective is perhaps not going to get us what we desire. So I just showed you the example of telecom. I want to sort of use the same analogy and say, how do we think about this in finance? So we have an objective. We want universal financial inclusion. We have regulators and policymakers come up with this idea. We mandate banks to do some kind of branch openings. We mandate banks to do X, Y, Z. In some ways it works, but we never measure the costs of doing that. We have very little, we've put in very little effort to put in the foundations of a market-based approach, and some of that is reflected in the comments that Monika had made. We've never really set up the ecosystem, and I want to argue here, which is, why is it that that ecosystem doesn't exist? Why is it that firms like Simpa that the panelist was talking about are not coming up in the space of finance? So why don't we have innovative products in finance the way we've had in other markets? Okay, and here are some reasons why I think that viability is a problem in finance. So first, I think we have very bad licensing requirements where the state actively prefers less competition in financial services provision. Monika did allude to financial repression, and I think that makes capital even more scarce in a scarce capital country. And of course, that also poses as an entry barrier. And I will give you some examples of the policy decisions that we have made at the top that have a bearing on financial inclusion at the bottom. Again, Monika has talked in detail about failures of consumer protection. And finally, there is regulatory uncertainty. And I want to give a few examples about how that regulatory uncertainty translates into private sector decisions to enter the market and provide these services. Okay, and so what this does is that it leaves very little to innovate and find solutions that that ail this financial sector in India. So let me give you some examples of licensing requirements, right? So we've always had very limited entry in banking. Since 1991, only 14 bank licenses were given. So in a country as large as India, why is it that we have such a restricted banking sector? So of course, we have curtailed competition. When we give out licenses, we put out very strict regulations on what these banks can and cannot do. Sometimes we don't take a view at all. So for example, we have all been talking about fintech and P2P lending, and we think that that's going to solve our problems, and it might. But until today, we are not very sure what the guidelines on P2P lending are. And in fact, I quote a recent Economic Times article where a lot of P2P players are saying that, this affects their fundraising and expansion plans because I don't know what you're going to want out of me. I don't know what the rules are going to allow. We impose very high capital requirements. So if you look at any of our regulations, we have we regulate NBFCs that don't take deposits in the same way as we regulate banks that do take deposits. Recently, there were these regulations for prepaid instruments that were just sort of payment instruments, and we imposed very high paid-up capital and net worth requirements. So, of course, that creates an entry barrier of who can come in. And I mean, I'm not saying that there should be no capital adequacy, but can we perhaps have the conversation saying what is the risk of this particular institution or instrument, and is the capital adequacy norm commensurate with that risk? And I don't think that we are having those discussions here. And if we put up these kinds of entry barriers, where is the competition going to come from? Where is nimble finance, as we say, going to come from? And I think that that's part of the part of the reason why we don't have innovative solutions in finance. Financial repression, again, I mean, Monika talked about it. We have problems in the bond market that have been spoken and written about for the last 20 years. Within banks, we have very high SLR requirements. We don't allow our pension funds and insurance funds to invest in anything other than GSECs, I mean, marginally only. We put limits on foreign investors, so we can't raise capital from them. So if I as an MFI, I can't borrow cheap, how am I expected to lend cheap to or expand operations when that capital does not exist? So, where is the capital going to come from? Where is the competition going to come from if we don't build an ecosystem that allows for the same? I'm not going to go through failures on consumer protection because Monika has talked about that quite a bit. I will focus instead on regulatory uncertainty. So, I'll give you two examples, and if I get started, I mean, I can come up up with various examples that will keep you here for an hour. So here is one example. We make sudden policy changes that make scaling up extremely difficult. So some of you may know that we had a pension scheme called as the NPS Swawalamban scheme. This was a scheme that gave a co-contribution to informal sector workers. And there was a huge effort made at rolling out this scheme across India. Lots of aggregators were given licenses. And, selling pensions is hard. Telling a poor person that your money is going to be locked in for 30 years, but, invest in this is hard. And companies had started doing this. There was uptake. The persistence was improving. And within 3 years, you came in and said, oops, sorry, I don't like this scheme. I'm going to replace it with what is called as the Atal Pension Yojana. How do I as a distributor invest in, getting people to invest in long-term products if I'm not sure what the policy environment is going to be like? Okay, why is it that we continuously change policy every few years? Because that again makes scale difficult. And if the NPS Swawalamban scheme was a bad scheme to begin with, why was it implemented the way it was implemented? Could we not have done better pilots to figure out how to go about it? The second issue that I will like to raise is, lack of reasoned orders. So if as a private player, I don't understand why I am being banned, not allowed to do X, Y, Z, I just don't know what to expect from the regulator. So here is one example. RBI order, there's one RBI order that refused the, one American company to start a payment services company in India. That's fine. RBI has the prerogative to do that. But can we have a reasoning as to why is it that this company was not allowed? Because other private sector players can learn from that order and then think about, okay, what is the regulator thinking about X versus Y? Here's another example. A team of people at NIPFP analyzed the Insurance Regulatory Development Authority orders. These are penalties that are levied on insurance firms. And they found that similar penalties have very different offenses. And there is no reasoning why one company was fined this way, whereas the other company for a very similar offense was fined another way. Now, as a private sector player, I don't understand how to navigate this landscape. Okay? And if there is such regulatory uncertainty, then it also becomes in some ways an entry barrier where I am not going to take risky decisions. I am not going to take decisions where I don't know what the regulator's view is going to be. And therefore, you will not see different people come in and, different products take shape that are addressing niche markets. So what is the way forward? I think that our strategy so far of forcing financial institutions, mostly banks, to do financial inclusion, forcing them, mandating them, basically has meant that banks see this as an obligation and not as an opportunity. And we have to understand and accept that unless there is commercial viability, we are not going to see the private sector come in. And we then have to ask, why is it that we are not seeing commercial viability in this space? Okay, so what is it that is impeding commercial viability? And I think that we need to begin to reorient that question and say, are there policy features in the landscape that inhibit competition, that inhibit viability? And of course, we need to balance the free-flowing private sector with needs of consumer protection, because otherwise we are back to square one. And I think that, if we want financial inclusion to happen, we need to build an ecosystem where, as Dr. Lahiri said yesterday, you should allow, let 1,000 flowers bloom. Thank you.
Thank you, Renuka. Now, I think I'm going a bit astray by making a few points, but I thought I'll add, since I've been looking at this problem. Now, first thing I'll say is that the RBI has brought out a report of the Committee on Medium-Term Path of Financial Inclusion in December 2015. You may want to have a look at it. The report is exhaustive and it has 79 recommendations. If I even spend 5 minutes on each recommendation, you'll be here for 6.5 hours. So let me be selective. The first question to be asked is that Tarun, in his paper, shows that the share of physical assets and institutional loans go down with education. As income levels improve, the infrastructure improves, the problem of financial inclusion may disappear. But today he dropped the bombshell that it's not the idiosyncrasies of the Indian households, that that is also responsible. It's not only low education, low income that explains why they save so much in the form of physical assets. So even if education improves, income improves, you may find he did the decomposition where he showed that it's not going to be with increasing income exactly like other countries. So we cannot sit quietly and assume that as the country develops, financial exclusion problem will disappear. My second point is, I think in this debate about, or in this talk about financial inclusion, there is too much emphasis on credit rather than mobilizing the savings. If you look at Sharada, Sahara, Rose Valley, this shows that the poor people do save. And they do put their money in some organizations. The chit fund industry, I was looking at the numbers, there's some 10,216 registered chit companies with a turnover of 30,000 crore. Now the question is, as many of the panelists have shown, that there is a supply side failure. The situation is not as grim as they pointed it out to be. If you look at what has been happening in the last 3-4 years, let me not make it an advertisement campaign for Bandhan, but there are quite a few microfinance organizations and NBFCs which are regulated entities which have come in and they're doing well. Lending to the poor, mobilizing their funds can be good business. It's not simply, you're not being a Mother Teresa. You're making money and helping the poor. The second issue is, or the third issue rather, is Jan Dhan Yojana. I think the Prime Minister Jan Dhan Yojana, which was, even the earlier government has done the basic no frills accounts. We have made progress. The total number of accounts, I think, is some 20, some 9 or I won't tell the number. It's a huge number, and IC 360 shows that 99% of the households in both rural and urban India have at least one member with a bank account. The problem is of dormant accounts, and because there are rumors that the government is going to put 10,000 rupees or there will be some free insurance facility, some people who already had a bank account, they also opened this Jan Dhan account. But now what has happened, there is a correspondence between the number of dormant accounts and the number of multiple accounts. And since you're seeding the accounts with Aadhaar, this problem will disappear because direct benefit transfer will be with only 2 Aadhaar seeded accounts. So you'll find that these accounts will die. Now, Rajnish made a point about the electronic and internet connectivity. Now, if you look at the Digital India website, there's something like 56,000 villages which do not have internet connectivity. Now, if you talk to any bank, there's a major problem. How do you do core banking solution? How do you operate point of sales machines? How do you operate handheld machines if you do not have internet connectivity? The question is, do we wait for internet connectivity to come, or can we do something about this problem in the interim? Now, several of the panelists have mentioned that there's a regulatory failure, but I found both the voices. Monika, maybe they're saying the same thing. Monika was saying there is no truth in disclosure, a term which I learned from Dr. Jalan. He had mentioned it long time ago, that there must be truth in disclosure. Now, Monika's point is there is no truth in disclosure, or you basically drown us in small print. Now, in this situation, Renuka, what you said about let's liberalize, let's be more liberal with regulation, there is a problem. You must decide whether you want to regulate more or you want to regulate less, and is there a moral hazard problem? Now, here, apart from regulation, I find that Governor Raghuram Rajan had mentioned 5 Ps about financial inclusion. The first P was a basic suite of products. Second was ease of access and place of delivery, reasonable price of products, certain protection, and the right incentive for formal financial entities to operate profitably in this space. What some of you must think about is, how do you stop political interference from coming in and making a profitable business unprofitable? Because politicians often have bleeding hearts, and they may say, you saw that in Andhra Pradesh. Now with RBI regulation of this space, I think there is some comfort, but still this problem needs to be looked at. The last 2 points that I'll make is a direct benefit transfer is a great way, because direct benefit transfer, what it does, once you have an account, it seeds that account with money. And once you have got this money, there is still a risk that will the money come in and immediately be withdrawn, because if it is withdrawn immediately, since an account to operate costs about 100 to 150 rupees for a bank per month, if there is no money there, it's not a profitable business. So you must have some money in the account, but DBT may be a good way to start. And the last point I want to make, which you may want to focus on, is in financial inclusion, what is very important is proximity-based strategies. Financial inclusion will not come in just with technology. You need human beings to go and hold their hands, to tell them what the product is. You must be able to take the money back at regular intervals. So given that you have to customize your product to suit the local tastes, and you need to be close to the clientele, are you expecting all banks to operate profitably for financial inclusion, or will there be niche banks which will be at the vanguard of moving this financial inclusion forward? I'll stop here and open up the floor for discussion. So let's start from here. Karthik.
Thanks for a great panel. Just a couple of very quick clarifying questions. Tarun, in that asset matrix, where is livestock? I mean, for India, just is it?
It's in durable goods.
It's in okay. Monika, I think that was both chilling and illuminating. So I guess the quick question on the insurance side is, why does this equilibrium persist? Is it incompetence? Is it capture? I mean, given our politicians usually step in whenever there is problems of this sort, if people are just losing their money, losing their installments, why isn't there any pressure to do something about that? So I'll table that and you can get to it. I think getting to Rajnish's point, and more generally, I think, and also connects to something Renuka said, is I think in the long term, falling transaction cost and falling intermediation cost will do a lot more for financial inclusion than all the mandates in the world put together. So, it feels like, that's certainly how we're going to make progress. So one very concrete question is, has this combination of Aadhaar and seeding started also a credit rating revolution, so that, you're kind of basically building credit histories and profiles? Because even 5 years ago, when I was asking people, I remember Nachiket saying that each bank would kind of sit on its own database and not share that. So I don't know if we now have regulatory environments like what we had in the US with the TransUnion's Equifax experience. So that allows credit repositories to be common, that allows a reduction of transaction costs of the credit space. And final question for Ashok is this question about savings versus credit. I thought the basic problem is that credit is much more profitable than savings, right? So if it takes 100, 150 rupees to run an account, is it commercially viable? For banks to be offering small savings products, or just even having these accounts, or at what point does that break even for just the savings product to be viable?
Professor Cole?
I'd also like to commend the panelists. I think that was very, very interesting body of work. I have one question or comment or a proposal, I guess, for regulatory framework. I guess the Nobel laureate Allais claimed, I guess, in 1940s or 50s that in each industry one firm should be nationalized so it could set a benchmark for appropriate levels of profits. And we did some work on life insurance mis-selling in India. We did audit studies where we sent people in to ask for recommendations. And we actually found that LIC agents were much more likely to make bad recommendations than the private agents. So at least in that case, Allais' conjecture didn't seem to be borne out. But it seems like one path forward would be, if you look in the U.S., the 30-year fixed mortgage market works pretty well. People do a pretty good job of shopping around and getting relatively low-cost mortgages that are suitable for them, and default in that market isn't that high. It's I think, and one path forward, for example, in life insurance would be to designate certain standardized products, a 10-year term cover with 1 lakh insurance, and no additional fees, et cetera, then the insurance companies can just compete on the annual premium they charge for that. And there could be some standard disclosure. You could then give the insurance companies some safe harbor, saying people can't claim mis-selling on this particular product because it's simple and it's standardized and it's easy to shop around, and then come down more heavily on regulation on products with more bells and whistles. And it may be that I'm just taking this from the playbook of some regulator, that this has been done in the UK or somewhere else, but that seems like one way, because part of this whole day and what I'm anticipating tomorrow is sort of just the challenges of trying to get things done well, and when the government just has limited capacity, and there's no wand we can wave to magically improve government capacity. So trying to think of bright line rules that are relatively simple and easily enforceable, but will result in competition from the private sector and good outcomes for customers.
So a couple of, quick questions.
If you could mention your name, please.
Yeah, I'm Rohini Pandey. I think I have my sign here. So, to Tarun first, you said India looks different, but if I compare India and the US, they'll probably look different on pretty much everything. So, I was curious if you thought of looking at countries with not just, comparable GDP, but comparable income distribution, perhaps more importantly. And whether we could say anything about how different or similar they looked. The second, which is building off sort of Mr. Lahiri's optimism on Aadhaar. One thing that Aadhaar will bring to the forefront, which in some sense was missing from all of this, is Aadhaar as an individual ID. A lot of what was implicit in the discussion was this idea of the household as a single unit. The government right now, and in fact no players are thinking seriously of what does it mean to start doing things like transfers on the basis of individual IDs. You talk to any state government, one of the first things they'll talk about is how they have to try to figure out how to create household registers or household groups around individual IDs. There's also a sense that the default, apart from something like Ujjwala, which is seen as a woman's good, is it's all going to go to the household head. Very unclear what that's going to do for, say, insurance within the household or risk sharing within the household. So from a lot of what I've seen, the extent to which Aadhaar is actually going to bring about this revolution, it's very unclear right now because we have very limited sense of how the individual is going to relate to the household. And you see that everywhere. Finally, coming to what Renuka said, I don't think we should be looking for commercial viability. Financial inclusion by definition is going to have a lot of aspects that are going to require long-term subsidies by the state. We have to accept this upfront, and we have to accept the fact that banks or private sector agents have incentives to behave the way Monika talked about it. And so you see this all the time. Right now, every system says, financial literacy will be done by the bank. No bank has any incentives to do it. We talk about last mile, we'll send things like SMS accounts. Go to most banks, they'll tell you that, tiny and small accounts are the ones they will not send SMS accounts to because they're very expensive. Go into any bank CSP point, they really don't want kids coming with 1 rupee to deposit. That has huge transaction costs. So if we're serious about financial inclusion, we have to accept that this is something that will require subsidies for a reasonable amount of time, and the question is how to do that right. But at least I don't believe that this is something that the private sector will find commercially viable.
Dilip?
So first, comment on Renuka and Monika's presentations. I heard Monika say that there's a need for strong regulations, and I heard Renuka say that there were too many regulations. And I guess then Renuka sort of went on to say that we should be balancing regulations with the need for consumer protection. And I guess you know each other very well, you work together, but it would be nice to harmonize the 2 points of view here. I'm willing to believe that we have all kinds of stupid regulations and not enough of the right kind of regulations, but I think it would be helpful to sort of somehow complement your 2 presentations into a unified narrative. But let me move on to the point that I really wanted to discuss, which is I think what Karthik, Rohini, and Ashok have already raised. So we need technology to promote financial inclusion of the poor, especially in rural areas. So either for direct benefit transfers, UBI, borrowing, lending, microfinance, you name it. And it's partly a technology issue, and it's partly a behavioral issue. And it's a trust issue, it's an awareness issue, and so forth. So on the technology side, I mean, I'm pretty skeptical about using bank accounts, given the issue about, the dormancy of bank accounts and all the stuff there, the distance that a lot of, people in villages have to bank branches, 7-8 kilometers. They often have to take off the whole day to go there. They don't know what to do when they enter a bank. They don't know anything about the forms. They need some local bigwig to take them, who gets his cut from whatever payments they receive from the bank account. I mean, I've seen this in my experience. Others have reported it. I haven't seen any studies exactly of the leakages involved in transfers through bank accounts. I'm skeptical. Add to that problems of connectivity, electricity connectivity, of internet connectivity. So I think the hope is in mobile, in telecom-based interventions. And there, I think we are, M-Pesa and all that, we've heard of all the impressive advances in Kenya. We are way, way behind. So 2% in India is against 58% in Kenya. So what is the prospect here technologically? So if it's all going to be related to Aadhaar, so somehow there's got to be some mobile, solution using Aadhaar. I don't know how exactly mobile is going to interact with Aadhaar. I guess this will all have to be battery operated, moreover, for people who don't have mobile phones, who don't know how to operate all this, maybe you can explain to them what they're entitled to, but they need to go to some local agent. So we will still need agents. We'll still have to be intermediaries. And I guess there would be some kind of extension of banking correspondence. But right now, the system of banking correspondence we have is just not working. I think the banks haven't figured out how to use banking correspondence. And I've done a lot of work on this problem of intermediation and the last mile. I think there's a lot of thought that needs to go into designing this interface with the poor, person in a remote village before we can think of direct benefit transfers or successful microfinance.
I don't know whether it's Devesh or Devesh, yeah.
This is a query for Tarun. Your work sort of shows that Indian households have very high fraction of their assets in sort of real estate. And I was wondering if you could help us understand why that might be the case. So one, plausible reason is that the rate of appreciation of real estate assets in India is faster than in other countries, so it might make the best financial sense, right? So if that's the case, is there evidence? It could plausibly or alternatively also be that, they just perceive no other alternative, and this is the only thing they are aware of. So there's no other alternative type of explanation. I'm just wondering if you could shed some light on that.
So should we ask the panelists to, please, go ahead. Please announce your name.
Good evening, everyone. Myself, Abhishek Agarwal, and I'm an intern at NCAER. So there have been some doubts regarding first we need technological inclusions before we go for financial inclusions in villages and remote areas of the country, right? So there was a doubt from the panels, I don't remember who was it. So they said that we can't operate in villages where we don't have internet connection, right? For the banking, and how are we going to implement Aadhaar basically works on the biometric information of a person, right? So how are we going to utilize that biometric information in connection with a bank account without a data connection, right? So I'm currently studying at BITS Pilani. So students from our college, they recently developed a system in which you can use a fingerprint scanner with a simple mobile phone or a smartphone, you can say, So that what that system does is, it takes your biometric information, it converts it into hash codes or security codes, make a SMS automatically and send it to the bank. All right. So there is no intermediary. You can just it's for banking system. So the banks could just hire or appoint you can say panchayat, means sarpanch is always there in the village, right? So you can give a device to the sarpanch with a fingerprint sensor. He would just take the fingerprint. You select what you want to do with your bank account. If you want to transfer some money, just enter the phone number or the Aadhaar number of the other person. Put your finger on the fingerprint scanner, and the transaction is done. No intermediary. Yes, there are possibilities of cyber data leakages, but they will always prevail, right? So you can't cure them, but it would actually benefit the villagers.
Okay.
So my point was that technology, we are advancing as technology.
Thank you very much. Should we start from Monika?
Yeah, how would you like to do that? Shall I address all the questions?
All the questions, yeah.
Okay. So
how would you like? In fact,
Or
when she's
we can-
answering one question, if any one of you
Yeah.
have anything to add to it, you can stop and intervene. Okay.
Thank you. Thank you very much. Karthik, I'll just start with your question, and that's something I've really thought about, that when it's such a bad deal, why do people keep going back? Because you are getting 1.3 trillion rupees every year still as insurance premium. And there are 2 or 3 reasons. One is that the person selling is a person known to you. He's either a relative or a friend or a nephew or a niece. And there is this whole emotional sale of the product, that I will lose my job, I will, so I'm amazed at how well it works. That is one. The second is that the banks are still trusted in India, and the bank will sell the product. The vending is happening at the bank branch. So everybody in the bank branch, from the minute you walk in, has a cut on that commission that they will earn. So the person that information will tell you that, oh, come. So the mis-selling is happening at the banks. Third is just fraud. They are just simply fudging signatures. So those are 3 reasons possibly where these sales continue to happen. Yeah.
So again, I'm speculating. I don't know why, but I think that because insurance is seen as something that richer people buy, I don't think that politically it makes as good a story than, let's say, a microfinance where it was supposed to be poor people that were the targets. So I think that it doesn't become a big political issue is because of the segment that is seen to be, or therefore not seen to be a victim.
And your question on why the regulator doesn't, so I think there is sort of, it's in denial. There's a denial with the regulator. I have dealt with the regulator for over a decade now, but I think they're just in denial that there is a problem in the market. They call it misbuying and not mis-selling. So they're constantly pushing the problem at the consumer rather than understanding that the game that they have set up is very badly flawed.
But here I had a question for the panelists as well as here. If you look at the disclosure of, say, insurance companies or mutual funds in the United States or Europe, is it any different? There also I find it goes into pages. By the time you have read 2 paragraphs, you are sleepy. So you said, to hell with it, let me buy it just.
So I do know about the UK disclosures. And again, as I mentioned in the Bose committee, we attached a disclosure of LIC selling a traditional plan, a participating policy. And that disclosure is worth looking at. It is very good. So they do solve some of the disclosure problems in the other countries. Can I take the next one?
Yeah, please.
Sean said that.
Let me make one point to follow up there. First of all, buying life insurance with savings is a bad idea. You buy term life. So in the US, if you are quasi-financially literate, I don't think anybody here who works in the US, you buy term life insurance for, and then you save in a, defined contribution plan or a defined benefit plan, but you do not link the same way. So that product actually, generally, most of us would never buy that product, which is a savings component and a life insurance component. So,
Tarun wanted to add.
which is basically it's a bad product. It's a bad way to save.
Sorry, so I think interest rates in
Yeah.
India were extremely low, then a whole insurance product might have been something closer to reasonable as a savings product, but those days are long gone.
Yes.
Also, there wasn't anything else. So, I mean, to be fair to LIC and the way the insurance was set up, there was nothing else. There was nothing else to target a long-term corpus. So it was really a thing, it was about safety of the principal more than anything else. And to that extent, LIC did very well.
I mean, one thing I'll say here, and this is not my view, it's just a view that I've heard. I've heard a lot of things recently, but is that it's a complicated product to sell, far more so than other products. This sort of relates to one of your questions earlier, Karthik, which is how do we get people to sort of purchase a low ticket savings product when the cost effectiveness of that might not be particularly high, and then what's the difference between that and taking on a credit product? I think it's probably fair to say that there's a hierarchy of comprehensibility for different types of financial products. And I think one has to sort of take that into account whenever thinking about solutions. Credit is something that people want because they have personal needs for credit, and so they're going to come knocking on your door for credit. Savings is probably something that on Maslow's hierarchy of needs probably comes a little bit later. Insurance is something that most households, I think, I've heard the view expressed, find this a difficult proposition, cognitively speaking. This is not because people are stupid. I mean, for a very long time I thought I was immortal. I've now come to the realization, sadly, post 40, that my body is falling apart, and I've now purchased some life insurance. So I think it's important to recognize that there are some of these sorts of basic psychological issues that we need to take into account.
I, on the other hand, stopped my life insurance.
Okay, next question was deposit, whether it is profitable. If you don't have, on that I'll tell you, see, any credit organization has got a funding problem. So how do you fund it? And funding deposit is not a bad way of funding it. And if you look at what the banking industry calls NIM, net interest margin. Net interest margin can be as high as 8, 9, 10%. So if you can, and mind you, the fact that Sahara and Sanchayita and all these chit funds are doing so well, the poor people can, even if they save something like 1 or 2% of their money, and they actually keep it sometimes in a very illogical way, like cash, idle cash. And if you pay 4, 5, 6% interest, you will get that fund. So my point is, in fact, it also brings to Rohini Pandey's point about subsidy needed. Some of us believe that lending to the poor need not make you a poor bank. You can be a rich bank, you can be scrupulous, and at the same time make money. Doing business with the poor need not be poor business. So I don't think, there may be a few dimensions of financial inclusion which may need subsidy, but if the regulatory infrastructure or environment is right, you will find enough clever Indians coming in, honest clever Indians, who will try to make a good buck out of this business. Am I correct, Tarun?
Yeah, no, I think that's probably reasonable. I mean, I think it's right that there are incentive problems in most markets, but that's true in retail financial markets as well. I mean, if you don't regulate consumer financial products, consumer products more generally, you'll get poison beads, milk that basically doesn't work. We've seen scandals like this in China. You get exactly the same problems in.
May I make a point here? And that is, we've been talking about, the questions that I've seen come up are based on the existing banking structure. Dilip, in your point that, I entirely agree with you, the existing model will not work. And that is why there is so much of innovation. You look at Philippines, you look at Indonesia, you look at Kenya, there are so many innovative products coming up. So you have to redesign these products. So it's basically a mechanism design product, a problem, okay? You cannot take the old banking models, branch banking that you was talking, it just won't work. That is not profitable, that won't work. The mechanism for initiating loans will not work. And Karthik, your question about FICO scores and other things like that, I've been tooling up. I was told about that I have to be on this panel a couple of days ago, so I have just been tooling up on this stuff. So somewhere I actually have read there is enough information now that they can, have very accurate scores as to your risk.
In
profile
fact,
and
you're
things
right.
like that.
If you
So I couldn't tell you where I read it, but one of the places.
you don't stay in India, that's why you haven't been bombarded with it. In my internet, I keep getting
CIBIL,
know your
score.
credit score.
Yeah.
The credit information companies are all over, and now the RBI has asked them to
Give one free report every year.
cooperate in terms of data sharing. So, particularly when you're lending to the poor, what you want to know, how many institutions have they taken a loan from? That information is available
now.
and it's part of documentation that is needed for a bank to lend to a poor person or any person as to how many sources of financing it has.
Sorry. Also on, so I have 2 points to make on the credit histories point, and then I'll answer the question on regulation. On credit histories, as you will see more payments solution, like being able to transfer money through WhatsApp, being able to transfer money through Facebook accounts, I think you'll suddenly see the big data revolution in using all sorts of other metrics like your telephone bills as a metric for credit quality, and I think it's slowly happening already. The other point I want to make on credit histories is, we are talking about finance here, but I want to give an anecdote, which is that somebody at some other conference once mentioned that, if you have collateral, this was more in the context of slightly larger firms, but I think the point holds that north of the Vindhyas, you can't get a loan even with collateral unless you know someone in the bank. South of the Vindhyas, you might get a loan with collateral, but without collateral, forget it. And the underlying reason is that, I might give my house or land, but dare you come and seize it from me. I have my goons and I will, not allow you to seize those assets. So we have a fundamental problem in, how seizure of assets, bankruptcy, collection happens, and those problems are also related to our law and order problems, and they haven't been solved. So no matter what you do on credit histories, I think until you solve these underlying problems, you are going to have this kind of a market. Shall I sort of answer the question?
Please, the other questions, please go ahead.
Yeah, so on the...
Can I add to that point,
yes.
Renuka? So I completely agree with you. I think this is a really important point, which is you sort of have to apply Bayes' rule on guys you haven't seen before. Because what we're not talking about is whether you have a credit registry, about whether you've taken credit. If you're talking about financial inclusion, you're talking about people who have no credit history, and you've got to get them into the formal financial system. So how do you do that? You take their characteristics and you apply that to a model which you've estimated from a whole bunch of other guys. So, as you correctly point out, the more data you have, the easier the inference becomes. But there's a dark side to this, which is that you can get discrimination very quickly in situations like this if you're not careful. So you've got to sort of think about those kinds of problems as well. So
And I just want to add to this, and I'm still coming at it from the supply side. So you set up these credit history firms. Now there are 4 in India, and very often each of them will give you a different score. So then then you're shopping your credit score.
Let me add now that is technology going to solve this problem? At least from the little I've seen of Grameen, BRAC, Bandhan, it's a very human resource intensive industry. So when you have the doorstep service centers, these boys and girls actually go, they find out where the poor household live, what kind of utensils they have, whether the husband drinks or not, whether the children are going to school or not. They're very detailed information. And they have an incentive system. So you have, say, 6 boys and girls staying in one place and going from village to village. They spend time with the sarpanch. So credit information may be important at the board level or at the headquarters, but at the ground level, you have to rely on that brilliant boy or girl who is saying, let's lend to this guy. And the advantage is, I must tell you about lending to the poor. One of the things, when I give you a loan, I may take quarterly installments. But when you lend to the poor household, you actually make it monthly if not weekly, because you will not default right after a week. You may, after a year, you may come back and say, no, I can't repay. So I don't think, at least as far as lending to the poor is concerned, it will continue to be a human resource intensive industry, and training and getting the right people will be critical for success.
Shall I pick up on Sean's question on, you were asking about why can we not have over-the-counter products which are very difficult to missell and then the rest is advised? Again, you come back to the regulator, because IRDA has tried that. It has put out a set of products, lowered the education requirements for the agents who sell them, but they've not really sort of understood that term product is the only product which will fit into that bucket, and they've included all of the others with all of their problems. So yes, they've tried it, but in the wrong way.
You had a question, follow-up question on something.
I just had a follow-up comment, which was actually based on working with a different bank other than Bandhan in Calcutta, which is BWS. So they cited that the poor need to be lent at this very rigid schedule because they need to be taught fiscal discipline, and this is the first time loan is very, I agree with you, very widespread. And there's also a certain amount of, I think, regulatory appreciation of it. But if you think about it, not from perspective of financial inclusion, but even from perspective of maybe a bank who's thinking about the upside, this is not how we give out venture capital. And so what we did in Calcutta, and actually now Sonata is doing in UP, is if you actually try to give grace periods, so much more the kind of lending with middle class, you also see higher returns. There is potentially a downside of lower repayment rates. And so I think that's where, in some sense, I think exactly what you said about how banks can be sustainable with the poor, it hits, because what you do is you can potentially be commercially successful by having products which are actually not very good for having poor be good entrepreneurs. So again, if you think about the equivalent being the small and medium financing in the US, compare that to microfinance in India. India microfinance repayment rates are 98-99%. SME financing, small business financing by the government in the US, default rates of 15%. The contract terms are negotiated firm by firm. So I think in some sense we also have to decide how we want to treat the poor, and whether then in some sense we want to just manage them consumption smooth and risk safe, in which case, yes, maybe commercial banks can do it. But I think otherwise you will need subsidies.
You're right, absolutely right. But as an aside, I must say, when Rajnish said that this problem of financial exclusion is also in the United States, I am reminded I had met Muhammad Yunus in Dhaka with the ADB president, and he said he was opening a branch in New York. I thought it was vanity. I didn't realize that even New York needed Grameen. And they had the same model of repayment and so on. Shekhar, you had a question.
Since we have the pleasure of having the chairman of Bandhan Bank, one of the only two banks that have recently got a license, and referring to a lot of the issues about entry. So is the problem the RBI faces that there's such manifest poor behavior on the supply side that there's almost a fear of allowing new entrants, because they'll do exactly the same thing, you'll have more bad characters in the game? Or is it vested interests who are in one shape or form ensuring that there are barriers to entry? Because it is incredible to have the kind of population that we have, the kind of underbanking that we have, and not allow innovation and entry. Because the two sometimes go hand in hand, and I suspect that Bandhan, which has taken one approach to certainly rural banking, the other awardee of a license, IDFC Bank, has taken a completely orthogonal, 180 degrees different approach. So since I'm sure you looked at all of this very closely, or your colleagues did at Bandhan Bank, is there some insider knowledge about what side? Is it this fear of allowing more bad entrants into the market, or is it the absolute lacunae of regulatory capacity of the kind that certainly, if all 5 of you were regulators, you probably would do a very good job and had the power to enforce those regulations. So that was one question. And the second was about the FSLRC, which is the one big kind of framework that we have now gotten. Many parts of it have been implemented. None of you have spoken about that. Does that offer hope? Is that a pathway out of the current situation that we have?
I'll only add this, that see, if you look at the history of banking in India, mid 1940s or late 1940s to early 1950s, particularly my province is very famous for that, there was the Bengal banking crisis. There were many Bengalis who opened banks, and all of them went under. So I think the history of banking is replete with, when you are relaxed with the licensing of deposit-taking institutions, you can do all sorts of things with others, but I'm sure the panelists will also say you have to be equally careful with insurance, you have to be careful with, whenever you're dealing with other people's money, I don't think the regulator, you can't be very lax in licensing requirement. You have to think of capital adequacy. You have to think of cash requirement, liquidity management, and all these things have to be looked at. I don't think we are being practical when we say that banking will make entry very easy. Now, even look at payment banks and small banks. There's a capital adequacy requirement, there's a geographical restriction, they have reporting requirements. You can't be lax with deposit-taking institutions. At least that's my view. And I don't have a vested interest.
He's in a privileged position to make that point, of course.
Since we're talking about capital adequacy, and I want to also react to Dilip's point about what I said about regulation. So I'm completely on the same page with Monika when it comes to having regulations that solve for consumer protection issues. And I think that the way we do regulation in India is that whenever you have a consumer protection issue, the only lever we seem to know is microprudential regulation. Let me give you an example. The 2010 Andhra Pradesh microfinance crisis that we know of was essentially a consumer protection crisis. So there was, loan collection problems, there was coercive collection. The way we solved that problem was to make all MFIs sign up as NBFC MFIs. We said now you have net worth requirements, you have capital adequacy ratios, etc., etc., etc. Right? And so, the question I want to ask, and when I say that we don't do regulation well, is that, what is the risk? What is the problem, and what is the lever that we are using to solve that problem? And I often find that we use the wrong levers to solve the problem, and therefore we don't solve them. And we have all of these, intense capital adequacy ratios that, in my view, inhibit entry. And I agree that when there are deposit-taking institutions, you need to be more careful. But I want to point out to the recent PPI regulations, which are just prepaid instruments. Why do you want to have such high capital adequacy ratios for those? And that's sort of taking the FSLRC. The FSLRC view was that whenever the regulator issues these regulations, can the regulator show us a cost-benefit analysis? Or why is it that you're putting XYZ restrictions, and what is your reasoning behind these restrictions? So have you studied the risks, and how are you coming at that? And I think that on a lot of these issues, we put these limits, but as regulated entities or as citizens, we don't know why there are these restrictions. And I think that on a number of issues, we just put extremely high capital adequacy ratios, and I think that really prohibits entry.
There are two pending questions. One is on the real estate, which is for Tarun, and the other is Aadhaar based and bank. Tarun, you want to go with the real estate first?
So you asked a question, Devesh, about is it the fact that there's a higher rate of return historically on real estate and so on and so forth. I think it's basically a combination of a lot of different things. We've done a fair bit of analysis on this, some of which I obviously didn't show today and isn't in my IPF paper. Look, I mean, there's clearly extrapolative expectations about rates of return. It's obvious that some of this is also coming from tax evasion motivations because it's easier to sort of secrete assets in places where, you know, the land titles are not great and so on and so forth. There's actually a standard, sort of interesting behavioral issue here as well, which is that people like tangibility. That seems to be a sort of aspect of things that also ties into the gold issue. There's a sense of inflation hedging motivations that are going on. Whether they're well placed or misplaced is another question. And there's actually not just a pull factor from real assets, there's also a push factor away from financial assets. Especially if you have to fill in 200 different forms and have a guy with a microscope show up at your house, then it's probably something that you're not going to be particularly comfortable taking on. Now, of course, the question is, you know, so there's some interesting issues here. So there's a partial equilibrium way to think about this, which is suppose I move guys away from real estate and into something else, what's the expected rate of return on their portfolios? But there's also a general equilibrium question here, which is suppose everybody piles into real estate, then what happens to real estate prices? You know, clearly you get bubbles, right? I mean, especially if guys are sort of moving away from fundamentals. So you can sort of construct equilibria where this is the case. So in some sense, you have a question about, do you want to be in a high physical assets equilibrium, or do you want to be in a sort of an equilibrium where people are pricing assets according to fundamentals? And so, you know, we know that moving, you know, from one place to another can sometimes be difficult. And I suspect that there's some sunspot arguments that you can make about why we're here rather than why we are somewhere else. And I think we could be somewhere else, and I think it would be better. But there are some questions about how you get there. So, I mean, I think it's a complicated question, but I think the answer is a combination of all of those things. If I can just add one thing, get back to Rohini on something. So, look, I mean, I think your question about you know, why compared to developed countries is a great one. I mean, I think the answer is because, I mean, when Ashok started out, he said, you know, can we just grow our way out of these problems? I mean, is this something that is naturally going to get better? So there's a view that says once education improves and once we get income distributions that look very different from the ones that we have right now, yeah, I mean, it's obvious that India is, you know, in one point in the sort of world distribution of income, and the US is in a different place. But, you know, there's a view of the world that, you know, all nations converge to exactly the same point eventually. Okay, and I think that's kind of what we're trying to tackle with this stuff. And I think what we're trying to come up with, and I think what we do in our IPF paper, is to say that kind of doesn't work. There's enough unobservable variation in the cross-country distribution that even if you were to grow at a particular rate and get people to have the same educational distribution, income distribution, and everything, you don't get the same balance sheets at the end of the day. Okay, and so we need to think about which balance sheets we want to get. I mean, I think the other part of that philosophy is that, you know, you correctly pointed out that you can't just create a mini version of a product for the poor and say you must impose fiscal discipline. You can't have Germany telling Greece what to do, just like you can't have the rich telling the poor what to do. That's absolutely right. But in some sense, you kind of have to demonstrate that first before sort of going on to the next point, and that's kind of what we're trying to do.
On Aadhaar, there were two issues. One, Rohini, you asked that Aadhaar is an individual's identity card, whereas many of the interventions are for the household. Now, if you look at the average household size in India, it's about 5.5 to 6. There are families which are bigger, but that's the average size. So 2 young children, husband, wife, maybe 2.5 children. Now, head of the household is being, or one representative is being taken. And let me link it up with Dilip's question that DBT, will it solve the problem? If not Aadhaar, is there a better alternative? You mentioned the point about mobile phones. Now, again, mobile companies like Bharti has set up a payment bank. Now, DBT will have to be transferred there. Now, whether the last mile, whether you can take the money from your mobile phone or not, even a bank can do that. From a bank account, it can be transferred to a mobile. The issue is, you have said you have to make payments, you have to give kickbacks, but that is there even in any other form of payment. So I don't think, I mean, at least I don't find any solution which is better than the Aadhaar-based solution right now. The Aadhaar-based solution through a bank or a payment institution is the best solution. Is there anything better?
You have to go to the bank, right? In a bank-based solution.
But you can go to the ATM, you can go to a
ATM will work only if there's electricity.
And there's another thing that is, now
Bank
we have
corres-
mobile ATMs, which will come, you have little ones which are, but you need internet connectivity, okay? Lot of villages do not have internet, but as long as you have internet connectivity, you have mobile ATMs. So basically, you can just do it anywhere. The other thing to catch, when you mention mobile phones, you have to make a distinction between a mobile phone and a smartphone. Now, for payment mechanism, a mobile phone is fine, but for anything else, you need a smartphone with an app. So basically, you have apps which are tied to the Aadhaar number right now, and you can do a lot more with that. But the number of smartphones in India is way less than the number of mobile phones. So that's another.
Dilip, it's interesting. I've heard stories when a poor man goes to an ATM machine, I'm standing there, I tell him, I'll help you, but you have to give me $5. But what you said, a person going to the bank and trying to withdraw his or her money, someone is asking for a kickback, that I haven't heard of. Is there examples of that you go to the bank and you can't withdraw your money without giving any money?
You don't even know, the chowkidar will not let you in. Who are you? And you don't know what to do when you enter.
So can I just add a little bit to what you said about the smartphone and mobile banking? So what is happening now is that the apps, and again it'll only be on a smartphone like say WhatsApp, they are now using the Beam network to start.
Right, that's what I was going to allude
So
to, yes.
yes, I've got the Beam app.
Yeah.
I don't find myself using it, but the minute WhatsApp allows me to write Beam, I'll be pretty much using that very soon. So
It's very cheap.
happening. Yes.
Very cheap.
Yeah.
Yeah, please go ahead.
Dilip, I think your point is extremely well taken. I mean, I think people generally tend to underestimate the feelings of shame and embarrassment that are both perpetuated by the system and inherent within people that make formal banking systems extremely difficult for them. And I think you're absolutely right that we need to solve for those problems. I mean, we've heard anecdote after anecdote of guys standing in the corner of the bank for hours waiting until someone will sort of lead them by the hand and take them someplace, and more often than not they get turned off for long periods of time from actually wanting to engage in those transactions. And I think you're highlighting something extremely important. Now the question is, do you use the current infrastructure to solve for that problem, or do you find a different solution? I think it's got to be a combination of it.
See, on the bank mitra or banking correspondent model, one complaint that people have is that it's not working because they're offering a salary. Some of the banks, I'm not talking of any particular bank, some banks are reportedly paying only 3,500 to 4,000 rupees salary. With that kind of a salary, you are not finding the bank mitras, as they're called, banking correspondents, working well. But as soon as you make the local kirana shop owner or some other guy, post office or someone like that, a bank correspondent, it will work. I think we haven't still given it a chance. I'm hopeful that it will work.
So I'd just like to follow up on that. Why is it that we haven't given a chance? Just to address the lead point. I think the young man there had a point. I can say from the last 4 years, being part of a group that has been sort of working with the government, the fintech, payment system, etc., technologically the problem is eminently solvable and has actually been solved. And in terms of access, both geographically and income-wise, that I think the problem is lickable, if not licked, if you want to. The problem arises in two parts. The one is some of the social dimensions, but I think even there, if you look at what is happening in different parts, and I'm talking about both admittedly peri-urban areas, etc., and young people, they're very adept. And I'm talking about people who are in very low income occupation. There is the other issue, which is of arcane regulations. And this is where the technology problem is quite severe. Let me tell you, I myself spent several hours trying to just update my Aadhaar address. And I'm a person with a rental lease, etc. I just decided I have the time, I'm going to do it myself, unlike in the past where it could be done by I couldn't do it online, etc., etc. And so I eventually went to the Aadhaar thing. And there you see some of these dimensions. People who needed to be helped, they had to solicit help, and all sorts of messes were occurring. Eventually you can get it done. But I think the point then arises, the point that Rohini was making. In spite of dramatic lowering of cost, first of all, I would say that the dramatic lowering of cost that technology has provided, I think universal access becomes affordable even with subsidies. There is also a huge amount of misallocation by banks and others of the costs. So if you want to, and this used to happen in telecom, you would say that rural connection cost me so much, but if you work out the economics of it, actually providing access to a remote customer improves the value to the rest of the system. This classic case of network externality. So I think universal access to these type of things for financial inclusion is possible technologically, but there's a whole plethora of arcane regulatory thinking and mindset at the level of, whether it was RBI, and I can give you n number of examples, and some of these were detailed by the group that was set up by the payments, group that the finance people set up. So I think that needs to be addressed. I really don't think there's a technology problem. Just to give you an example, think about wage levels in the US. Some time back, would you think of 49-cent transactions or 99-cent transactions which would ever be viable? And to get the sorts of receipts, iTunes, those are million. Just work it out. 49 paise transactions should be okay, because it's zero marginal cost effectively. So I think technologically the problem is solved, but the mechanism design has to be rethought of right from the back, and I can give you n number of examples of people are doing it. Unfortunately, it always gets caught up. It goes back into the banking system or the RBI, and that's where the bottleneck is, and it's a problem of the mind.
So let me give you one more example. A penny a share. For stock trading, the costs have come down dramatically. It's just unbelievable that you can. A lot of people will charge you a penny a share, and you could even go below that if you are going to transact in bulk. So technologically, I've talked to a number of people. This problem is solved in large database. We could have this thing implemented. Question is, the overlays that we have on this.
If I could just continue. So with banking correspondent, you're saying, why doesn't it work? Well, I have been experimenting with a product where we appoint an agent who's a local money lender, or is somebody who's appointed by the local government. And that person is the intermediary, and that person gets a commission. The commission is based on the transactions. So in particular, if it's microfinance, this guy recommends local farmers for a loan. In fact, the loans are, Rohini's experimented with extending the period to 2 months. We've gone to 4 months. Okay, so it's a lot more flexible, but the repayment rates are the same. It's about 97, 98%. Whereas, with hers, more traditional, it was about 80, I think it dropped to about 80%. So it is possible to attain high repayment rates, and all it needed was this mechanism design approach to designing an incentive compatible contract for a local intermediary. But with that, with the results, I have gone to NABARD, I have gone to Reserve Bank of India, everybody expresses interest, but nobody wants to operationalize it.
But it's why did you go to NABARD? It's for an individual bank. A bank is totally free to have.
Right. I've talked to individual banks. They say, okay, very interesting academic presentation, but
will not do it.
There just isn't that spirit of innovation and experimentation.
I'd like to come back to the point that I made about regulatory uncertainty, right? If you don't know what to expect from the regulator, you are obviously very scared of, taking these innovations because you don't know what's coming next. And I want to, again, give one example where there was a firm that was trying to sell money market mutual funds to poor households, and things were going well, and suddenly one day the regulator said, sorry, you can't do this. If you really don't know what to expect, you're just not going to step out.
Dilip, tell me, when instead of taking the money back weekly or over a month, when the installments are due after 4 months, Was the rate of interest adjusted to make the net returns the same? Or was there an incentive problem?
No.
It was adjusted. The net return would remain the same because when I get your money back
Yes.
from the first week onwards,
Yes.
my return is higher.
Yes.
So if I get the money back only from fourth month onward, I must increase the rate of interest.
Yes.
It was adjusted.
Yeah. And you asked me why I didn't go to a bank. Well, I actually went to Bandhan Bank, and I sat down with Mr. Ghosh. Mr. Ghosh was extremely interested in doing this with me. We actually worked it out and we priced it. And then he started applying for the bank license, and he was nervous about the regulators. And he said, once I become a bank, I have to be very, very careful about the regulators. So I don't want to do anything risky.
So this was before the bank was open.
This is just about a year before.
So, sir, I just want to say one thing that, there are two things which are happening. One is that firms are getting constrained because of too much regulation or regulation which is restrictive, and consumers are not getting protection because of the lack of adequate regulation. So there's obviously a mismatch in the kind of regulation we have and the efficacy of what you need on the ground. So that mismatch is happening. And could it be that regulators have a dual role of development as well as regulation?
Protection.
So if we look at, again, telecom, when the development role was taken away, then businesses could do what they did. So if regulation can be rethought in terms of takeaway, it's not really the business of the regulator to develop the market, because then you become an industry association.
Look, that's completely right. I mean, I'd like to escape from technological evangelism for a little bit. I mean, I think it's all well and good to think that technology is going to solve a lot of these problems, which I'm sure it will. But we have some fundamental financial problems we have to deal with as well. For example, suppose you say, I can debit 1 rupee from everybody who's at an extremely low ticket size. But the point is, I can't give someone a diversified portfolio or a piece of an index fund with 1 rupee unless I build a product, a financial product, and I need to understand the constraints of the financial system that either prevent me from doing that or allow me to do that. So these are ultimately finance problems, they're microeconomics problems, they're not just technology problems that we need to solve. I mean, there's lots of...
It's a combination.
That's right. It's a combination of...
I could sell you a very diversified portfolio for $1.
Exactly.
I just part of
But you need to figure out how to
So you need the robo-advisors in
that's
place. Yeah.
whatever it is, but you need to build the infrastructure.
Yeah.
to be able to do it.
I think, Dilip, Rohini, you have a good question. Dilip, the issue that is coming out too is that you're offering a proposition which is profit-making to a financial institution. And it's a win-win situation. It's good for the customer, it's good for the company, and still the company is not showing any interest in taking that product. That's the major point. I mean, why this inertia on the part of a bank?
Well, net of regulation is a negative net present value.
No, but I don't know of any regulatory problem with that. When you say that instead of after a week you will take it back after 2 weeks, I don't know of any RBI regulation which tells you that you must take it on every week. That I don't know. Rohini?
So on the RBI regulation, I think what there is a regulation on is when a loan becomes more than 1 year.
That's true.
And that's the reason, for instance, when we did a 2-month, the reason we couldn't do more than 2 months is it was a 44-week loan. You can go up to 52 weeks, but if that becomes a 2-year loan, it ends up in a lot of other issues. So there are constraints that will come, even if they're not obviously on that feature. Another thing I'd say, which it doesn't sound like it came up for you, but I think is true in general, is that a single bank often will not go with something new because the other players in the market have not changed. So a common concern you heard is if borrowers have multiple loans, I move to, say, a month or a 2-month, I become the last person the borrower is repaying. And that just means that if that borrower is then in any kind of financial distress, I'll be the first bank that's hit. So I think that's, again, the kind of reason why, I guess people often call this why you need regulatory sandboxes, where the regulator actually creates the space for experimentation, because there are lots of reasons any single player may not move. But I guess I just want to make a very small comment, is that when we talk about technological problems being solved and look at I'd say something like iTunes, it's for a given level of literacy or a given level of financial sophistication. I'm not convinced that we've solved the technological problem when we actually price out the amount of money it would take to make someone sufficiently financially literate to behave the same way as an American teenager, say, who we think was maybe the most financially literate, behaves in the US. And that technological problem, I don't think, has been solved in terms of making it cheap
I would
enough.
agree with you, and I would hope that somebody would have brought up the discussion on financial literacy, because that is a big elephant which is nobody has talked about, nobody brought it up. And without some level of financial literacy, none of these problems are going to go away.
So, I mean,
Record is very mixed in terms of very financial literacy
so, I'd just like to add a small point on financial literacy here, which is that we've often been thinking of financial literacy as numeracy, which is that can you do 2 plus 2 is equal to 4? Okay, and I think that we need to move away from that view of financial literacy to perhaps literacy as understanding what my rights are. So I may never learn how to do 2 plus 2, but at least I am more aware of what my rights are, who I can go to solve a problem, who I can go to for advice. And I think that if we reorient our discussion on literacy in that manner, perhaps we will see, better outcomes because people will be able to demand better outcomes.
Okay, the allotted time is over. I don't think we have the panelists. Do you have anything more to add?
No.
Thank you very much. I think I learned a lot. And thank you, panelists, for a very illuminating talk. Thank you.